Well, we've seen First Bank return to profit in the first quarter, with the bank having posted a pre-tax profit of 15.4 billion naira compared with a 9.8 billion naira loss a year ago. Reported PAT in the meantime translated into an earnings per share of 42 kobo, slightly above many forecasts that were out there ahead of results. BC Onasanya, GMD at First Bank of Nigeria, joins us now from our studios in Lagos. Thanks so much, BC, for joining us this afternoon. Well, quite a turnaround we're seeing in the business, despite revenue coming in 10.7% lower than that of the previous year's figure. Surely the story is all about the lower provisions for risky assets, where last year we were looking at 38 billion compared to this year's 1.5 billion naira.
Sorry, I lost you there, please.
BC, just looking at the figures that were out.
It's not just about loan loss provision. Yes, I got you now. Now, looking at the numbers, it's not just about reduction in loan loss provisions. You would also see that we've made conscious efforts to bring down our cost of funds, which was a major challenge we had last year. Now, in this particular year, our focus is obviously to increase value to shareholders by increasing profitability, which was a major issue we had to deal with in the last financial year. Yes, I agree with you. There will be greater focus this year on reducing the loan loss expense, improving the asset quality, but more importantly also bringing down cost, so that in terms of a return to shareholders, we become once again the clear leader in the Nigerian market.
From the figures, it looks like costs have become somewhat of a challenge. We've seen the company's cost-to-income ratio rise to 65% from 51%. Managing costs, just how much of a challenge has it become for you?
In an environment like this, the major challenge you have when you have pressures on increasing your revenue is to make sure that you tackle the costs. We are doing everything, including in making sure that we put more effort on using technology to serve our customers, which on its own has a dual effect of bringing down the cost and also improving service customer satisfaction. So we are tackling costs from the perspective of interest expense and also general overheads. Now, if you break down the cost, you would also notice that once your loan loss expense comes down, it has a bigger effect on your total cost. Now, the major items on the cost line is staff cost and interest expense, together with loan loss provisions. And we are tackling this year those three parameters to make sure that at the end of the year, we don't make money on the right hand and then throw the money away through those items. But I need to add also that because we have one of our core strategies is to make sure that we have the best people within the Nigerian banking system. We will not cut costs on staff costs simply because we want to reduce costs. We've got to be able to make sure that we have the best people, and to have the best people, you need to pay them very, very well. So yes, we have a big task ahead, but I can assure you we are on top of the situation.
Well, certainly, BC, when you're looking at the NPL ratio, it's down to 6.9% from 8.2%, and that certainly shows some improvement in the asset quality through the downtimes. Which sector represented the most or the highest incident of NPLs for the company?
Well, we had margin facilities, which was in the financial institutions, but beyond that also you have in the manufacturing sector. And so we would make sure that with the strategies that we have put in place to increase our risk acceptance criteria, and also with closer monitoring of customers and loans, we would tackle the issue of asset quality. Now, you have a reduction in asset quality, you have an improvement in asset quality in the first quarter, bringing it down to 6.4%. Our challenge is actually to bring down to about 2-3%, which is the target for the current financial year.
That's the target for this year. Let's look at some of the strategy you're employing in that regard. How are you diversifying your loan book, and what direction would you like a diversification to go in terms of exposure, sector by sector, but also client, on a client type basis?
Now, we have a portfolio that has been clearly defined in the current financial year. We have clearly allocated credits to specific industries, which are industries expected to drive the growth in the Nigerian economy. We would move away, for instance, from margin facilities, and we have presently put some measures in place to make sure that we don't go back into those kind of situations in which we had. But more importantly, we've also adjusted our risk acceptance criteria to make sure that only good credits sail through. In all this, we should also not overlook the fact that people and the relationship management is very key to the asset quality that we end up having. We've for once now decided, and we are now making sure that all our relationship managers have targets to ensure that they have a minimum non-performing loan ratio of not more than 2%, and that is being measured. Part of the strategies going forward is to use 4 key indices to measure the performance of the bank. Now, we are looking at growth through organic and inorganic means. We are looking at service excellence, but the third part of it is performance management. Now, our people are clearly driven. They know exactly what we want. If I take you back to what we did last year, we grew in size, but that was what we wanted to do. This year, emphasis has moved away from growth to profitability and asset quality.
Well, that's just some of the factors that we're looking at influencing some of your growth moving forward. How are you positioning the bank in view of the opportunities for mergers and acquisitions in the country, BC? I mean, they're arising from the need to recapitalize those banks that were recently bailed out by the CBN itself. How are you fitting into that entire scenario?
Yes, thank you. We do have a clearly articulated strategy for growth. These are driven by a combination of 3 factors: organic, inorganic, and a combination of the 2. And this is clearly spelled out in the strategic plan document for the bank. We will look at every opportunity in these areas, but clearly only institutions that give us value will be addressed. Now, if we have opportunities to acquire any of those banks based on the clearly defined parameters that we have documented, we know exactly what we want in any of those institutions. We would look at those opportunities and will only take anyone that fits perfectly into our strategy.
So possibly some of that, BC, coming to the
kind of a transaction.
Sorry to interrupt, but we're running out of time here. So very quickly, just to end off with, I mean, what is your Africa strategy? We know that you have managed success in Nigeria itself, but very briefly, where does your Africa strategy come in? Do you have one?
Thank you. Yes, we do have a strategy in Africa. We have a strategy to expand into 5 countries in sub-Saharan Africa, but it's clearly documented and we are in the process already. I cannot disclose the countries at the moment, but next year, after the consolidation of our leadership in the Nigerian market this year, next year is to expand into sub-Saharan Africa. And we have a strategy document already. We are implementing, and by the end of the year, we would have moved a step closer to the attainment of that objective.
Well, hopefully in the course of that,
we'll
get you back in studio just to run through that. Unfortunately, BC, we're going to have to leave it there. We've run out of time for today. For that, BC Onasanya, GMD at First Bank of Nigeria.